mentioned a bit earlier, just in the last comment about a regulation pushing interest away. I'm curious, is this just anemic for the industry, or is just a further indication that we're closer to the bottom?
Well, look, unfortunately, we'll know where the bottom is or was only with hindsight. What I can say is that we have definitely been through periods like this before.
Right.
When we combined low volumes with low levels of volatility, which are very, very difficult for our strategy. Volumes are obviously higher in absolute terms today than they were back in 2019, 2018.
Yes.
But the difference is that we've come off much higher volumes. When you go back to 2018, 2019, the volumes were on an increasing trend in many ways over some medium-term period of time. So it feels a lot more difficult. When you look at the graph that you're showing up, it really does feel like a collapse from a very, very high level.
Especially the velocity of it, I think.
Yes.
Scared people.
Absolutely. So there have been periods like this before. There have been periods during which, for example, we've underperformed versus the benchmark by actually a larger magnitude. It just feels that there have been, if you think of 2022 in many ways as the equivalent of the global financial crisis for crypto, it didn't really react. It reacted in price terms, but not necessarily in volume terms. And what you've really had throughout the course of this year is intense regulatory pressure, intense political pressure, at the same time when there are some pretty big problems that investors generally are trying to address at a macro level. So it's not as if this is a little problem in the corner. People are thinking about interest rates, risk on, risk off, recession, and so on. And you talked about last week. I think that it's difficult to point exactly what was the catalyst for the sell-off last week. There are many candidates, including a lot of negative news out of China, both in terms of business fundamentals, but also in terms of currency issues around the exchange rate. So there is a lot going on. From our standpoint, a decline in volumes affects us. It affects us because essentially in a lower volume environment, our systems interpret price movements as low quality and therefore tend to be less reactive.
There's a different perspective on counterparty risk, where some might say you have counterparty risk from the perspective, if you're box ticking, of whether or not a counterparty is regulated or not regulated, which is only one layer. And so the onus is on the manager and the fund to carry out counterparty risk assessment regardless of the regulatory framework. And so given the nascent period we are in crypto, especially in prime, should we actually look past regulation, whether or not a counterparty is regulated in the US or not, and not really rely on the regulations because that's simply a guideline, really, in a way? But if you were to use internal counterparty risk measurements, would you find actually stronger participants outside of the US? I think is where I'm getting at.
I'm not sure I'm able to answer that question in a definitive way. I think that you need to be very cognizant of the direction of travel of regulation, because as we have seen, regulation very often is reactive as opposed to proactive. We've seen this in the United States, and it's somewhat puzzling that there should be so much political vitriol versus cryptocurrencies, right? I mean, it's somewhat unusual. I think that particular aspect comes from the embarrassment of FTX. I think a lot of people in government and politics generally felt somewhat embarrassed by the magnitude of that and the surprise of that particular issue, given that the reputation that FTX was establishing was one of regulatory leadership, compliance leadership, and so on. So I think there's a lot of embarrassment. But your point is a very good point. More than regulatory risk is your ability to engage in counterparty risk. I mean, we recognize that we're in an ecosystem where, amongst a lot of other things, regulation is embryonic. But so the regulation and the direction of travel, that's sort of an art more than a specific science. Getting a set of audited financials, right, that's scientific. You either have them or you don't.
Yeah.
When you have them, they're qualified or they're not. And then they're either strong or they're not. I mean, I don't really see any room for ambiguity there.
Yeah.
And collectively, the industry is seen to its cost, people being a little bit light on that. The one thing that I would say that has changed about regulation, I talked about it earlier, is that the moves that were clearly conducted by the financial authorities in the US to be very, very clamping down on banking organizations.
Operation Choke Points, I think they called it, right? That's what the choke point, yeah.
Because Choke Point showed two things. It showed the willingness to do it, but then it also showed the ability to do it, right? I think it's very arguable that Signature Bank was under any severe distress. And the GP had a bank account with Signature, and that was closed down simply because we're in the business of crypto. And I think that was very concerning, as it should have been.
When you look at Operation Choke Point, you look at, I wouldn't call it dubious, but it certainly raised an eyebrow when BlackRock applied for the ETF. The number, I think, on their successes on applying for and receiving approval for ETFs is more than 90%.
Yeah.
It appears that choke point and regulation and sort of even Gary Gensler's approach and his demeanor is to, and again, this is all reading the tea leaves, trying to pave the way for more TradeFi players to come into the space, including BlackRock and Fidelity, etc. It seems that the OGs, and I would still call them OGs like the grayscales, are getting pushed aside for many different reasons, some valid, some otherwise. How does this reflect on the US, and how accommodating do you think they're going to be for smaller managers or new participants to the market who don't have that homegrown brand name?
You're reading some tea leaves, and that is a narrative that has been espoused a little bit, which is a lot of these obstacles are being put up in order to open up, if you like, the space for traditional financial organization to come in. Look, in many ways, I welcome it. We welcome it. Cambrian welcomes the entrance of traditional financial players coming into the infrastructure of this business. I think it can only do good things. I think what's important is to go back to, why does this ecosystem exist? It doesn't exist out of nothing, right? Crypto projects are very early stage projects. And what is going to, over the long term, really push the growth or diminish the growth is going to be the success of projects, the use cases, utilization, et cetera, et cetera. And I think that the most important thing from a long-term perspective, not about a short-term price movement, but of a long-term perspective, is just to have a finger on the pulse of new project developments, funding rates in private markets. And I mean, I'll just give you an example, something which shocked me. There have been something in the order, and I forget the exact number, of 250 new tokens issued this year.
In a bear of bear markets.
Right. Now, a lot of them may have little end use ultimately, but we don't know. And so my point is, that is the real key long-term measure. And as long as that innovation in and of itself doesn't get whittled away, I think that we're moving in the right direction. Now, what we hear from some investors at the very early stage is that they're increasingly not financing projects that are domiciled in the US, right?
Yes.
Meaning new crypto projects, they're saying, look, the regulatory environment is uncertain. And so we're happy to finance new projects, but they've got to be in Hong Kong, Singapore, Switzerland, Germany, outside the US. And that would be, I think, to the huge detriment of the US angle to crypto. I don't think it's a detriment to crypto generally, but I think it's a detriment to the US aspect of crypto. But I'm sure that the US will wake up to that at some point.
I think you're right. I've been to conferences in both the US and in Asia here. There's one coming up in Singapore. There is definitely a big difference in the temperament and in the excitement. Now, a big part of that is Web3, which is different from trading crypto. But still, even when you look at the trading volumes of US counterparties versus global, US only accounts for less than 20% of volumes. And so I think that speaks to, this is not just a US-centric story. This is actually a global story, which there's a disproportionate amount of tension placed on US regulation, which I'm wondering whether investors will pick up on eventually. Tony, you touched on staking. DeFi, I think most of us who are in the space would argue, at least of its former version, is dead. And it's not a space that your team has invested heavily in. Is there any hope for DeFi coming out into the next run, and what would it look like, if at all?
I think there is. I mean, we, again, taking a very conservative view with regards to counterparty risk, we don't trade on DeFi exchanges, but we will trade DeFi tokens. And it's not for us to say whether some of these DeFi tokens become immensely valuable in years to come. It is not an area that we're expert in, but there is no doubt that a lot of the potential really disruptive, there's many disruptive potential use cases for crypto, but one of them is squarely addressed in the financial sector. And I think that most people or most investors in very early stage investing, I've not spent my career in early stage investing, but I'm told that the way people work is they imagine the world of the future and they translate it back and kind of sometimes act and talk about it as if it's today.
Yeah.
And I think that is very typical of DeFi, but there are lots of things on DeFi that worked very well throughout the course of last year. Lower volumes, you can argue about counterparty risk and so on, but they worked well. I mean, the whole irony of what happened last year was that it really happened. It happened on a centralized exchange. So I have no doubt that there are use cases along with NFTs and art and music and so on that absolutely the financial world will get disrupted by. Again, I don't know exactly what form it will take, but as an example, an adjacent issue is tokenization is a very, very real prospect. And it's a prospect which we kind of relish, because if we have a trading system that we can really apply 24/7 to an increasing number of tokenized assets, I think that'll be good.
I'm really excited that you actually mentioned tokenization. It's something that, at least in Hong Kong, the regulators are looking very closely at. And this also touches on the question about RWA, real world assets. So 2 questions here. Why don't you think tokenization hasn't been taking off earlier? And number 2, what would it take for a hedge fund like yourself to start trading those types of tokens? Is it a function of infrastructure, liquidity? Because it appears to those of us in TradeFi that the obvious real use case is tokenization and real world asset type of products rather than utility tokens or chain tokens or proxies, etc. What are your thoughts there?
We kind of internal discussions we've had on this have been mere dreams of what a future world might look like. But there is no real reason why a lot of financial assets that you and I invest in, individuals invest in, institutions, why these things should not trade 24/7.
Yeah.
I mean, and what that does is what you have with crypto, in my opinion, is a very, very sophisticated price discovery mechanism for 2 reasons. 1, because it's 24/7, and 2, because it's a global process, right? I mean, investors in Asia have just as much opportunity to set prices than US investors or European investors or Middle East investors. That may not necessarily be the case in, Google stock or Facebook stock, US hours, US regulations, US disclosure, etc. And that's the beauty of operating in and around the blockchain, is you're opening the door to a democratization of participation. Now, you could say, my God, it's nuts, because all it's going to do is increase volatility. And that may well be the case. But, there's no reason in our mind why markets should close at 4:00, right? We get told that there are sort of logistical reasons and bookkeeping reasons, etc. But I think that cryptocurrencies show that it can be done, and it can be done well. Currently, that is the last thing that's on people's minds. But, in a world where assets trade virtually on a 24/7 basis, we're very interested. And if they're liquid, we're very interested.
This is something that it's both disruptive to the existing framework. When you look at clearinghouses and stock exchanges, etc., they're almost archaic when you look at how efficient, say, and I know we're not trading on a DEX yet, but the concept, at least the proof of concept, is already out on how these decentralized exchanges work. And even if you take the half step into centralized exchanges, they're operating 24/7 as well.